J&J beat consensus across the board this morning. Q2 2026 revenue came in at $25.3 billion, adjusted EPS hit 2.90, and management just raised full-year guidance, projecting they'll cross $100 billion in revenue for the first time ever.
Yeah, and the stock is already reacting. It's trading up nicely in the pre-market action.
It really is. So today's deep dive is zeroing in on Johnson & Johnson's official Q2 presentation and press release. We want to figure out exactly how they pulled this off. We're cutting through the noise to show you how this healthcare titan is navigating, massive patent cliffs and global headwinds.
Exactly, because hitting 12 figures in annual revenue, that is just a completely different stratosphere for a legacy manufacturer.
Yeah, $100 billion is wild.
It is. But as analysts, we really have to look under the hood of that 6.6% reported revenue growth.
Because in this environment, you see 6.6% growth, and your first thought is this just inflation?
Right, exactly.
Like with their pricing power, are they just jacking up prices, or are they actually moving more volume?
Yeah, that's always the big question. And what's fascinating here is how they separate those exact factors in the presentation. You really have to look at the distinction between their reported growth and their operational growth. Because for a global giant like J&J, selling in dozens of countries, currency fluctuations can heavily distort the reality of the business.
Right, if the strong U.S. dollar is penalizing them on paper.
Exactly. So when you strip out the impact of that currency translation, their operational sales growth was 5.6%.
Okay, so that's the true pulse of the business.
Yeah. It proves this is genuine, fundamental volume growth across their divisions. It's not just an accounting illusion. They are structurally selling more therapies and devices globally.
Which definitely makes that $100 billion target much more credible for you as an investor. It's actual demand.
Absolutely.
So to understand where that demand is coming from, let's split the business into its two main pillars.
Sure.
Starting with the largest, innovative medicine. This is the pharma division. And it brought in $16.38 billion just in Q2.
And that segment grew by a very impressive 6.8% operationally.
Right.
Now, when you dig into the segment results, that growth is being aggressively driven by their oncology portfolio.
Yeah, the cancer treatments are booming.
They are. We're seeing massive market share gains from therapies like Darzalex, Carvykti, and Tecvayli.
But here is where it's really interesting for anyone holding the stock, because while oncology is absolutely crushing it, their immunology portfolio took a serious hit.
A very serious.
Specifically Stelara. Stelara has been this massive cash cow for J&J for years, but it's finally hitting that dreaded patent cliff.
Yeah, the exclusivity ran out.
Right. And now competitors are just flooding the market. The presentation actually noted that the decline in Stelara alone dragged down the entire innovative medicine segment by 760 basis points.
Yes, and just to contextualize that, 760 basis points is a 7.6% drag.
That is a massive anchor.
It's huge. Stelara is facing really intense biosimilar competition right now, along with some unfavorable patient mix dynamics.
And just briefly on biosimilars, because retail investors hear that term a lot, it's essentially just the biologic version of a generic drug, right?
Yeah, exactly. Because biologic drugs are grown from living cells, you can't make an exact chemical copy like you can with, say, aspirin.
Right.
So competitors create a biosimilar which produces the same clinical result, but they can sell it for much cheaper because they didn't have to fund the initial R&D.
Which immediately undercuts J&J's pricing.
Exactly. It steals their patients.
So dynamically, it's almost like a sports team. Your franchise star, Stelara, is rapidly aging out and losing points, and they're essentially forcing the rookies, the new oncology drugs, to step up and carry the whole team.
That is the perfect way to visualize it, yeah.
Yeah.
What you're watching in this Q2 report is a real-time masterclass in managing that specific transition.
Because normally a patent cliff like this is a bloodbath for revenues.
Oh, companies can literally collapse under the weight of it.
Yeah.
But J&J knew the Stelara cliff was coming years in advance.
Right.
Their strategy was to use that explosive, high-margin growth in oncology to buffer the transition. Think about the math here. They absorbed a 7.6% drag from Stelara and still delivered 6.8% overall operational growth in the medicine segment.
Which takes incredible pipeline management.
It really does.
And they're also trying to rebuild that immunology bench at the exact same time. The report highlighted Tremfya as a major bright spot.
Precisely. Tremfya is the younger star stepping up. In this quarter, it saw huge growth across all its indications. And more importantly, it just got an FDA label expansion for psoriatic arthritis.
Right. The data showed it's the only IL-23 inhibitor proven to help stop further structural joint damage in those patients.
Exactly. By muting that IL-23 inflammation signal, it physically stops the joints from deteriorating further.
Which is a massive selling point for doctors.
Huge.
And it shows how J&J innovates to replace those lost revenues. They don't just sit around, they actively try to obsolete their own legacy markets with superior therapies before the biosimilars can completely take over.
They have to. But, it is a constant, exhausting treadmill. Even with that strategy, they're still facing immense headwinds. It wasn't just Stelara losing ground.
Right. I noticed Remicade and Simponi also saw decreases.
Yeah, driven by share loss.
And even in the booming oncology division, older drugs like Imbruvica and Zytiga saw declines. It really highlights how ruthless the product life cycle is in biotech. There's just no coasting.
Which is exactly why their pipeline velocity is so critical.
Definitely. Okay, so we have the pharma side fighting these biological battles against patent clocks. Let's transition to the physical side of the business medtech.
Yeah, let's do it.
Because if pharma is a volatile boom and bust cycle, medtech is a totally different battlefield. This is the medical hardware, the surgical tools, the vision products.
And it really acts as the stabilizing force for the company. MedTech brought in $8.92 billion for the quarter, logging a very solid, predictable operational growth of 3.6%.
And the growth drivers were super interesting. Electrophysiology is growing nicely with new tools. Then orthopedics, specifically knees and hips, saw strong demand aided by their VELI's robotic-assisted solutions.
Right. Hospitals are heavily investing in those advanced robotic arms for precision.
Yeah. And then surprisingly, vision was a strong contributor. Robust demand for AccuView contact lenses, aided by what management called strategic price actions.
Which is just corporate speak for, we raised the price and consumers paid it anyway because it's a premium daily product.
Exactly. But MedTech wasn't all smooth sailing, right? The surgery segment faced some really localized headwinds. Endocutters were down about 5%, energy products down about 1%.
Yeah, a little rough spot.
And on the call, management kept pointing the finger at VBP in China as the main culprit. Let's unpack this for the listener, because when I hear VBP, I'm picturing the Chinese government buying surgical tools like they're shopping in bulk at Costco. Is that what's crushing their margins?
That Costco analogy is actually incredibly accurate. Yeah. VBP stands for volume-based procurement. It's a specific policy used by the Chinese government to completely overhaul how they buy medical supplies.
Okay.
So instead of individual hospitals negotiating prices, the central government consolidates all that purchasing power into one massive bulk order.
Got it.
They go to J&J and say, we'll guarantee you massive volume, but you have to slash your prices drastically.
So they use their sheer size to force a race to the bottom on price.
Exactly. So J&J might still be physically selling a ton of endocutters in China, but the profit margins on those legacy tools are just getting completely crushed by VBP.
It turns highly specialized devices into low-margin commodities.
Precisely.
Which leads to my next question. If they are losing margin on high-tech surgical tools in a market as massive as China, can selling lots of AccuView contact lenses really offset that? It feels like trying to plug a leak in a dam with a Band-Aid.
Well, it's a fair question, but it's not just about relying on AccuView. MedTech's true resilience comes from relentless hardware innovation. The only way you offset commoditization in China is by introducing premium next-generation technology that governments are willing to pay top dollar for because it dramatically improves patient outcomes.
Right. Build a better mousetrap, and they can't force you into the bargain bin.
Exactly. Like in the cardiovascular space, J&J just launched the dual-energy Thermocool platform.
Yeah.
They also highlighted Shockwave, which was a recent acquisition seeing double-digit growth.
Okay, so when older tools get commoditized, they just rely on this newer, higher-margin tech to carry the load?
Yeah, it's the exact same dynamic we just discussed with Stelara. You literally have to invent your way out of margin compression.
It's a really fascinating parallel, whether it's patent expirations on biological drugs or government bulk purchasing on physical hardware. The defense mechanism is identical. You have to run faster than the competition through R&D. But engineering the next generation of robotic surgical suites and targeted oncology therapies, I mean, that does not happen for free.
No, it certainly doesn't.
It requires absolute mountains of cash. Which brings us to the financial war chest. Let's look at their capital allocation, because this is where the rubber meets the road for investors.
And the cash generation of this business is truly formidable. I mean, they generated roughly $8.7 billion in free cash flow just in this single quarter.
Wow.
Yeah, having $8.7 billion in flexible money over a 90-day period gives management immense power to structure the balance sheet.
And management was very explicit on the call about their priorities for that cash. It was fascinating to see them rank it so clearly.
Yeah, they didn't mince words.
Priority number one, organic growth. So
Right.
R&D. They poured $3.7 billion directly into research and development in Q2 alone. Priority number two, competitive dividends. They paid out $3.3 billion to shareholders.
Keeping the income investors happy.
Right. Priority three is M&A. They specifically called out the recent acquisition of Firefly Bio to expand their novel cancer treatments. And then coming in at a very distant priority number four, share repurchases.
Yeah, this ranking is incredibly telling for anyone following the stock.
It is. If you look at J&J's balance sheet, they treat their cash like a highly disciplined corporate diet. They are heavy on the R&D protein to build long-term muscle. They provide steady dividend carbs for immediate investor energy. And they go very, very light on the stock buyback dessert.
I love that analogy, and it raises a really important question about how retail investors should evaluate corporate priorities right now.
Because so many mature legacy companies are just aggressively buying back their own stock with their free cash flow.
Exactly. And look, when a company buys its own stock and retires it, the share count drops. So earnings per share automatically goes up, even if the actual business hasn't grown at all.
Right. It's just financial engineering. It looks great on a quarterly basis, boosts the stock temporarily, but buying your own stock doesn't invent a new cancer drug.
No, it's empty calories. By explicitly placing R&D and strategic M&A so far ahead of share repurchases, JNJ is sending a very confident signal to the market. They aren't trying to engineer their way to $100 billion in revenue through accounting tricks. They are aggressively buying and building the fundamental science required to secure their dominance for the next decade.
Because they believe their internal pipeline yields a much higher ROI than propping up their own stock price.
Exactly. When you're dropping nearly $15 billion a year on research and development, you're making a very loud statement about your internal confidence.
And that supreme confidence is clearly reflected in their updated guidance. They didn't just raise top-line revenue estimates, they also increased their adjusted pre-tax operating margin guidance.
By at least 50 basis points.
Meaning they expect to be more profitable on every single dollar that comes through the door, which pushed their adjusted EPS guidance up by 18 cents.
And we really have to note that margin expansion is happening despite absorbing those massive Stelara headwinds we talked about.
Right.
And despite taking a $200 million hit in Q2 for a supply chain restructuring program. They are just ruthlessly pruning inefficiencies in the background to continually feed that R&D engine.
So, to pull all of these threads together for you, J&J's Q2 report is fundamentally a story of successful high-stakes macro management. They're navigating the Stelara patent cliff by relying on explosive growth in oncology and steady execution in medtech.
Yes.
They're fighting off international pricing pressures like VBP through relentless hardware innovation. And ultimately, their disciplined investments in R&D are what give them the confidence to raise guidance and project crossing that historic $100 billion revenue mark.
It really is a masterclass in global scale. But, looking at the sources we covered today, it leaves us with a much broader industry dynamic to consider.
What's that?
Well, if a legacy manufacturing company like J&J is now forced to pour tens of billions into R&D and prioritize acquisitions like Firefly Bio and Shockwave just to replace aging blockbuster drugs,
Yeah.
are we entering an era where these pharmaceutical giants are functioning less like traditional product manufacturers and more like massive, fast-moving venture capital funds that just happen to have a global supply chain attached?
Wow, that is exactly the kind of structural shift in the market we need to keep our eyes on. Because the line between inventing the future and just outright buying it is getting incredibly blurry.
It definitely is.
Well, to make sure you never miss how these massive earnings reports reshape the market, be sure to follow the show for our daily earnings coverage. We'll be right here breaking down the numbers and finding the story so you don't have to.